Well, global markets indeed will be something that we'll be keeping an eye on all of next week. But moving on now, private equity funds have decided that it's better to collaborate than compete. And that's because deal sizes are becoming bigger and bigger. And fund managers feel that it's better to join hands to back these deals. If the recent trend is any indication, the strategy, at least for now, seems to be working. Arijit Barman has this special report.
Call it the power of the collective. As deal sizes go bigger and bigger and valuations go through the roof, private equity funds are increasingly joining hands to co-invest and share the risk and of course the rewards. For PE funds, teaming up keeps a check on valuations, and for promoters, it's always better to deal with a group rather than one strong financial investor who could turn out to be a potential predator in the boardroom.
Two main reasons. First is deal size, and the second is what the seller, the promoter, wants. So in the case of the Flextronics software deal where Sequoia co-invested with KKR, it was principally a relationship with KKR. It was a large buyout. In the case of IDEA, where there was a very large private equity round with several investors, we invested alongside Providence, CVC, Citigroup, Crosscap. It was what the promoter wanted.
It's not just big-ticket investments like Flextronics or Idea Cellular. 2006 saw similar co-investment deals across banking, healthcare and pharma, from Centurion Bank to Fortis and Morpan Labs. In the first 3 months of 2007, Goldman Sachs, General Atlantic and Safe Partners picked up 5% each in NSE for $375 million. Nimbus got $125 million from a clutch of investors, 3i, Cisco and Oman International Fund. While fashion house Provogue raised $33 million from New Vernon, Blackstone, Fidelity, Genesis Capital, Artis Capital and Liberty International. Other software infrastructure companies that followed similar strategies include ICSA and Ramkey Infrastructure. Often regulatory restrictions also force PE funds to club.
In the financial services sector and banks, the limit is 5%. So if a bank wants to raise more than 5%, they would have to go to more than one private equity fund.
Centurion was an example.
That's an example of that, where we, along with a couple of other funds, invested in the company and took a 5% stake.
While there are others, like realty fund Trikona Capital, who often hunt for deals with ILNFS for strategic synergies.
The objective of both parties to try and create the next generation of real estate projects, which could be brand new cities. Let's take that infrastructure expertise, combine it with the real estate expertise, start small, do some hotels, do some roads, then let's see what else we can do together.
Then there are issues which are as basic as friendship and personal rapport. In the close-knit PE and investment banking circle, it always makes sense to call in a like-minded friend with whom you have either studied or worked before. It's just a matter of mutual trust, which often leads to fund managers in the US calling in their counterparts in India to pull an investment in the same direction. With Sunanda Jaiseelan in Bangalore, in New Delhi, Arijit Barman for NDTV.